guys, welcome back to another video. I hope you had a restful weekend and a great start to your week. Now, once a month, I release a video talking about the general economic situation and how it affects our trucking industry. So that is the topic for today. If you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. By the way, we are officially over 40,000 strong. So thank you so much, you guys. I really love making these videos, sharing what I know about the market, and of course, learning every day from you guys. Anyway, let's get into the macroeconomic situation affecting our trucking industry. Ready? Let's go. So we're going to look at a few things today, starting with capacity. As most of you already know, capacity is a huge issue that is partially responsible for the fact that the rates are so low. There are simply too many trucks in the market and not enough volume to actually soak up some of that capacity. So first, we're going to be looking at FTR's new for-hire trucking companies. Now, this is as of February. So this is right here. You can see February, and I will attach these down below so you can see a little bit better. Now, according to FTR, there were about 6,200 new trucking companies that entered the market that were approved by the FMCSA as of February 2023. Now, I know this is a very scary figure, 6,200 new carriers in an already oversaturated market. And if we look closely, we can see that there was a peak in 2022 right here, and since then it has been declining, which is great. And for the past 5 months, there was a consistent decline until February, where there was an increase in new authorities. Now, even though people are still getting into this industry, let's take a look at what the net revocations are like for trucking. And this is again by FTR. And what we can see, and this is as of February right here, this is February, we can see that there was a decrease in net revocations. Now, just to give you an idea, in January right here, there were 9,250 net revocations. In February, there were 7,400 net revocations. So yeah, the number did decrease. Now, just so you guys know, net means it's the revocations minus the reinstatements of authority. So yeah, it did decrease, but it's still 7,400 net carriers who did shut down. So if we look at the net change in carrier population, which includes those new authorities that just entered the market, minus those revoked authorities, we can see that the change was still negative at about 1,200 carriers. So 1,200 carriers less in February than there were in January. And as you can see from this chart, we have had a negative carrier population change. There are less and less carriers in the market for 5 straight months. Now, in February, less people went out of business or closed their companies than in January, December, or November. But still, 1,200 carriers less in the market as of February than before. So what does this mean for us? Well, it means the amount of trucking companies is decreasing in the market. But does that mean that there are less dispatchable trucks? Because this is what we should be concerned about. Here's the thing, and I did mention this before. A carrier can shut its doors, they can sell off all their equipment, but those drivers, as well as the owners, might then opt to work for a bigger carrier. So that would suggest that while the amount of trucking companies is decreasing in the market, the amount of dispatchable trucks is not, or at least isn't at the rate that we're hoping to see. To get a better idea, we need to look at for-hire trucking jobs and whether those are increasing or decreasing. And thankfully, FTR has that data as well. I love FTR. Now, what we can see here, we're looking at the blue line, right? That's the total. And this is for hire trucking jobs. We can see that there was a decrease in February right here. Now, what this shows us is that the amount of for-hire trucking jobs decreased by 8,500 jobs in February. And this, according to FTR, is the largest drop since April of 2020, which is, at this point, this is good news. So yes, carriers are shutting their doors, the net carrier population is decreasing, and while some of them are probably still going to work for those bigger carriers, we do see that the amount of jobs are also decreasing, which suggests that the capacity is slowly leaving the market. Now, according to FreightWaves, which is the leader in trucking news and freight market news, basically people send them information, correct? They said that they have not been hearing of many sizable bankruptcies as of yet. Now, one of the most interesting things that I heard from them, and this was from a webinar that I believe was on February 16th, is that according to research, and I don't remember who they said was the one who did the research, but according to that research, they said that trucking companies usually can operate for up to 1 year at a loss before completely leaving this industry. And FreightWaves said that yes, while it has been a year since the downturn in the market, actually, the market really started getting bad in Q3 of 2022. So they predict a big exodus of carriers to happen only in Q3 of 2023. Now, I did get this chart from Sonar to just show you what they're talking about. So this is from March until March, so March 2022 until March 2023. And what we can see is tender rejection rates in white, yeah, they dropped quite a bit right from the get-go. But the volumes actually started decreasing only around the end of Q2, beginning of Q3. That's when the volumes started dropping. So they expect again that Q3 is when we are going to see that capacity start to really leave the market. Okay, now onto the demand side, and we're going to start with produce because produce is something everybody in this industry is right now relying on to push those volumes up and therefore push those rates up as well. Now, just a few days ago, FreightWaves did release an article and it's titled "Produce Season Likely to Be Weak and It's Bad News for Truckers." Now, I hate being the bearer of bad news, but I think that it's important for you guys to know what is actually going on in the market so you can better prepare. Now, as some of you know, California has been experiencing a ridiculous amount of rainfall in the past 2 months. I believe tomorrow the storms are starting up again. Now, according to FreightWaves, and I quote, "Massive flooding is preventing workers from harvesting lettuce, strawberries, and other plants right now, particularly in Central California. Workers have also been unable to plant crops like tomatoes. Around 20% of strawberry fields have been submerged underwater since March 10th. On top of it, some of those lettuce crops have to be tossed because they're kind of rotting because of the ultra wet conditions. Now, that being said, some crops will just be harvested later than expected. But we really need a good produce season in order to help us out here. It's actually unbelievable. Last year, there was a weak produce season because of the drought. And this year, it's because there's just too much water. Mother Nature seems to be pissed off at us at the moment. Vengeful lady, isn't she? The next thing we have to pay attention to is consumer spending, but not like we did in my previous videos. While consumer spending is usually a wonderful thing because the more consumers spend, the more we have to transport, we are currently facing a different issue. Credit cards. Currently, the average interest rate for credit cards, according to Forbes, is 24%. Yeah, that is insanely high. Now, consumers are still spending money, which is usually a wonderful thing because, again, we have something to transport, but it's not so wonderful when the interest rates are around 24%, and those consumers who are spending that money are putting it on their credit cards, accruing debt, and then are delinquent. Now, as of Q4, as you can see from this chart by Fred, which I will attach down below, these are delinquency rates on credit card loans, right? And we can see that as of this is up to Q4 2022, they are climbing. And currently delinquency rates are at 2.25%. So why is this such a big problem for us and for our industry? Well, because at one point or another, the chickens are gonna come home to roost, and these people who are delinquent will have to pay off their credit cards with an interest of, as Forbes said, an average of 24%, which is insane. So what is that going to do? Well, it's going to kill the consumer's buying power and therefore will end up affecting us in the future. Now, there is some good news, and I cannot believe I'm saying this is good. This is from the Forbes article, month-over-month variance, and we can see that the total spending for consumers did decrease by 0.4% in February, which is good considering those delinquencies and those ridiculous interest rates. We want those consumers to maintain their buying power as much as possible at this point. Finally, I'm going to leave you with some good news because I know that this video has been pretty pessimistic so far, and we're going to look at housing starts and permits, right? Housing starts show us how many projects are starting up. Permits show us what the future of construction will hold because they have to get permits before they actually start construction. And what we can see that as of around January, both the housing starts, which is blue, and the permits, they did increase, which is a really welcome sign. Why is it a welcome sign? Well, because all of those construction materials have to be transported, right? Usually they go on flatbeds, but sometimes dry vans as well. Now, paired with the fact that the weather should be getting better soon, we can expect more construction to pick up, and that means that flatbeds especially will see an increase in volumes, perhaps dry vans as well, but at this point, I'm seriously thinking of switching back to a flatbed. So this is what it is, guys. Is this my favorite video to make? No, not at all, because I hate being the bearer of bad news. And honestly, I can't wait for the moment where I start telling you guys that volumes are up and tender rejections are up, skyrocketing, and rates are $3 per mile on average. But I guess a little more patience is in order. Regardless, there are some promising signs. The carrier population is decreasing. The number of for-hire trucking jobs is decreasing, meaning capacity is leaving the market. Slowly, but it is leaving the market. To top it off, housing starts are giving me a little bit of hope. And of course, produce season, even though the weather is really crap right now and it's going to mute the produce season will still be there. Perhaps not as fantastic as we all hoped, but volumes will still increase. Anyway, guys, I hope you enjoyed this video and I hope you found a way to use this information to your benefit. Stay patient, persistent, and resilient, especially when it comes to rates. Like I said in my previous video, as hard as it is for us to believe, the market is in the carrier's control. We are the ones with the trucks. We are key players in the logistics chain. So the more carriers and drivers say no to bad rates, the more shippers and brokers will be forced to raise those rates, regardless of capacity or volume in the market. Anyway, wishing you all a fantastic rest of your week, and I'll see you in the next video.